Welcome to this explainer. Today, we're putting Allegiant Travel Company, ticker ALGT, through the ultimate financial stress test. We aren't just glancing at standard metrics. We're applying the distinct investment frameworks of legendary investors Warren Buffett, Peter Lynch, and Benjamin Graham, right alongside some rigorous quantitative valuation models. Together, we're going to break down this stock's core fundamentals so you can see exactly how it holds up under serious scrutiny. Let's dive in. Here's our roadmap for today. We'll kick things off with a quick snapshot, run the stock through the Buffett, Lynch, and Graham lenses, dive into some quantitative models, and then wrap it all up with a final verdict. Starting with Section 1, let's establish our baseline with a quick company snapshot. So what exactly are we dealing with here? Allegiant is an ultra-low-cost carrier, laser-focused on leisure travel. They fly 566 routes across 124 U.S. cities. But the real headline right now, they just acquired Sun Country Airlines. This is a huge shift, blending complementary networks and aiming to really strengthen their position in the value segment, especially in secondary leisure markets.
Looking at the current tape, ALGT is trading at $104.29. That gives them a market cap of nearly $2.8 billion. And they're pulling in some serious cash, with trailing 12-month revenues hitting $2.63 billion. Just to put that into perspective, their Q1 revenue alone was a record $732.4 million. So the top-line revenue engine is definitely revving, but we need to know how efficient the rest of the machine is. Let's find out.
Moving on to Section 2, let's look at ALGT through the Buffett lens, focusing on moats, management, and margins.
Now, as you probably know, Warren Buffett's framework is notoriously strict. He does not compromise. He wants a clear economic moat, consistent earnings power, manageable debt, and a high return on equity. Basically, he's looking for companies that can compound wealth safely and efficiently. The big question here, does Allegiant actually have a moat? Surprisingly, yeah, they kind of do. Management points out that about 70% of their passengers are repeat customers. They absolutely dominate these underserved secondary leisure markets, providing nonstop flights where the big legacy carriers just don't bother. But, and it's a big but, this moat is constantly battling the massive inherent risks of the airline industry. We're talking mainly about volatile fuel costs, which are estimated to sit right around $4.20 per gallon in Q2. And here is exactly where Buffett would slam on the brakes. The current return on equity, it's sitting at negative 3.19%. That is a far cry from its historical highs of over 15% back in 2021. You combine that negative ROE with a heavy $1.8 billion debt load and a tiny free cash flow yield of just 0.14%, well, the owner earnings look incredibly weak right now. For Buffett, there is just no margin of safety here. He'd demand a steep discount to historical book values before even blinking at this. So the Buffett verdict, a definitive hold or honestly a sell until that ROE turns around.
All right, let's swap lenses for Section 3. Here is the Peter Lynch perspective, finding growth at a reasonable price.
Lynch is the guy who really popularized the PEG ratio. That's price to earnings divided by the growth rate. A PEG of 1.0 is generally considered fair value. So anything under 1.0 tells us a stock might be undervalued compared to its growth potential.
And this is where Allegiant gets really interesting for a Lynch-style investor. Check this out. The stock is boasting an incredibly low PEG ratio of just 0.18. That is a massive undervaluation signal, driven by aggressive projected earnings growth that the broader market just hasn't fully priced in yet.
So how would Lynch categorize this? He'd definitely see it as either a turnaround or a cyclical play. Why? Because the fundamentals here are pivoting dramatically. Before the Sun Country deal, standalone guidance projected a 50-cent loss per share in Q2. But now, thanks to the integration, strong demand, and a massive 23% year-over-year jump in TRASP, that's total revenue per available seat mile, management completely flipped their outlook to a $1.25 profit per share. For a growth investor staring at a 0.18 PEG ratio and that kind of earnings swing, the Lynch verdict is a strong buy. Let's move on to Section 4 and apply Benjamin Graham's strict quantitative defensive filters to check for intrinsic value and safety. Running ALGT through Graham's defensive checklist gives us a pretty mixed bag. On one hand, it passes the size test with that $2.8 billion market cap. Its forward PE of 11.5 and price to book of 1.78 are also moderate enough to pass his valuation filters. But it completely falls apart on financial strength with a weak current ratio of 0.91, meaning its current liabilities actually exceed its current assets.
It also fails on earning stability because of that recent negative ROE, and there's currently a 0% dividend.
Let's actually run the math on Graham's intrinsic value formula. We take the square root of 22.5, multiply it by the projected earnings per share, and then multiply that by the book value per share. Using management's FY26 target EPS of $8, we derive the book value by taking the current price of $104.29 and dividing it by the price-to-book ratio of 1.78. That gives us 58.58. Plug all that in, and Graham's formula yields an intrinsic value of exactly $102.68.
So what does that actually mean for us? Well, with the stock trading around $104.29 and an intrinsic value of $102.68, there is literally zero margin of safety here. Graham was notoriously conservative, usually demanding a stock trade at just 2/3 of its intrinsic value. He'd probably want this price closer to $68 before he'd even touch it. So, under the Graham lens, this is a hold or sell at current levels.
All right, Section 5. Let's step away from the gurus and dive into some pure quantitative models, specifically DCF and multiples.
For our base case discounted cash flow model, we're explicitly pulling our cash flow assumptions straight from the source's projected $8 FY26 EPS and that massive 23% TRAS revenue bump. Using a weighted average cost of capital, or WACC, of 9.0% and a terminal growth rate of 2.5%, our base case fair value lands at $111.40 per share. But notice how sensitive this is to our WACC assumption. If capital costs creep up to 10%, that fair value instantly drops below $100.
Let's also look at a secondary model, the enterprise value to EBITDA multiples over time. Back in fiscal year 2024, this thing was wildly inflated at nearly 170 because of depressed earnings. It dropped to 9.17 in 2025 and currently sits at a much more normalized 10.95. So we're seeing some definite stabilization in their valuation metrics. Still, that DCF base case of $111 represents only a very modest upside from today's $104 price tag. Quantitatively speaking, this stock is screaming fairly valued.
Which brings us to Section 6. It's time to synthesize all this data and deliver the ultimate verdict.
Here's how everything stacks up. The Lynch lens is practically screaming buy thanks to the dramatic turnaround growth and that tiny 0.18 PEG ratio. But our DCF model shows it's fairly valued right now with a target of $111.40. And then you have Graham and Buffett, who both suggest holding off. Graham sees zero margin of safety at an intrinsic value of $102, and Buffett wouldn't deploy a dime until that return on equity gets a lot healthier.
Investing is all about balancing competing realities, right? On the plus side, that Sun Country acquisition is a total game changer, instantly boosting Q2 EPS to $1.25. They've also got strong liquidity at $1.2 billion and massive TRASM growth. But you can't ignore the risks. They're lugging around a $1.8 billion debt load, they're highly exposed to volatile fuel costs, and they still have to successfully execute the sale of their non-core Sunseeker resort just to refocus on the core airline business.
Blending all of this together, at the current price of around $104, Allegiant Travel Company is really a speculative hold if you're a defensive, value-focused investor following Graham and Buffett. However, if you're a growth or turnaround investor channeling your inner Peter Lynch and you're willing to bet on the operational synergy of the Sun Country merger, this becomes a highly compelling buy.
We've laid out the guru frameworks, we've crunched the intrinsic math, and we've explored the contrasting growth narratives. But the final variable in any investment equation is always your personal risk tolerance. Knowing what Graham, Buffett, and Lynch would do, at what price would you pull the trigger on Allegiant? Thanks for joining me on this explainer. Keep analyzing, and I'll catch you next time.